guys, welcome back to another week of Mortgage Matters in Minutes. I'm your host and owner of Mortgage Specialist, Brent Rasmussen. So today we're going to speak about assumable mortgages and the pros and the cons and things that you might not be aware of. Why are assumable mortgages so important? Because we're still seeing interest rates at a higher environment than we did 2, 3, 5 years ago. And that might impact some people. We've had lots of questions in regards to people going through a divorce or people buying a new property. And the assumption question comes up. So today we're going to talk about what makes a loan assumable and how you can take over and assume someone else's mortgage loan. So why do we want to chat about assumptions is because that individuals that are in properties currently might have a lower interest rate than what you can get access to in the market. So let's say an individual's in a home at a 3% interest rate and today rates are at 6.5%. Well, you sure would like that 3% rate a lot more than you would like to take on that 6.5% rate. So an assumption is not a refinance. It is still you taking over someone's property and taking over their loan moving forward. So that's what we're going to chat a little bit about and what kinds of loans are assumable. Generally speaking, FHA, VA, USDA loans are assumable. Most of the time, conventional loans are not assumable, but there are some conventional loans that are assumable, but maybe not at the exact same interest rate that you have available. So what you do have to look at is your closing disclosure to find out on the back page, first of all, if your loan is assumable or it is not assumable. So your closing disclosure is in your final closing packages, and it's the document that has all the final numbers broken down. But on the last page of that explains whether your loan is assumable or not. So how does the process work? And then one of the negatives, there are lots of positives, obviously, but there are negatives. And that with an assumption, you have to go to the servicing lender that has the loan to work through them to assume the loan, which means you still would have to qualify by their rules or by whatever FHA, VA conventional rules have been structured and set up to release that seller from liability. And we see this happen a lot, honestly, during divorce situations and certain situations of family that are maybe not completely married, but changing ownership and hands to take over that loan moving forward. And their intent is to keep that. So you don't get the shop interest rates. You're getting that interest rate that is in or on that property already with that particular mortgage loan. Another catch besides working directly with the servicing lender, which might be an 800 number across the country, is you have to make up the gap between what the loan balance is and the house value. So let's say you want to purchase a home that has a value of $350,000, but the balance of the mortgage loan is $250,000. So there's that $100,000 gap in there that you, the buyer, has to make up. And that's the challenging aspect of assuming a loan, is because over time, that gap keeps getting bigger and bigger. Values keep going up, loan balances go down, and so that gap gets to be stretched, and many buyers don't have that kind of available funds, and or a lot of sellers don't want to wait around 3, 6, maybe 9 months for the servicing lender to get that assumption done. So in essence, it helps the buyer take on a new lower payment, but the seller many times has to wait around a lot longer for them to get their proceeds. So they might not be entertaining that type of an option. So how would you know? If you're a listing agent, you do want to ask the individuals, what do they owe? Is their loan assumable? Let's check that out. So if you are a VA buyer or an FHA buyer, the assumptions are maybe on the table a lot better for you. Or if you're a first-time buyer that has a lot of cash, you might be able to make up that gap and get a much better loan by taking over that property. I can stress, though, that taking over an assumption does take time. It's not a normal 30 to 45 day close. That's my experience from what I've seen over years and years of other individuals going through this. Not to say that it can't happen quickly, depending on what servicing lender you're going with, but want to make you prepared going into it that there are a few speed bumps along the way that might make the process a little bit different to take over that 3% interest rate when rates are at 6.5%. Please let us know if we can answer any questions for you here at Mortgage Specialists. Our Mortgage Matters in Minutes are intended to be short and concise and sweet within 5 to 10 minutes. So you have a quick minute per week or minutes per week to catch up on local real estate finance and real estate talk of what's going on here recently. I'm Brent Rasmussen, owner of Mortgage Specialists, and just a phone call away at 402-991-5153, or you can check us out on our website, mtg-specialists.com. Have a great rest of your day. Mortgage Specialists. Driven, trusted, reliable.